In this video, we shall be answering a question that is faced by all investors, which is, why should I invest in mutual funds? All of us have some financial goals for the future, like saving for a vacation, buying a car, buying a house, children's education, children's marriage, and post-retirement expenses, to name some of the most popular ones. Now, to achieve these goals, we have a wide variety of investments that we can invest in. So then, why should we invest in mutual funds when we have so many other options? Whenever we come across such a situation in real life, the most obvious answer is to see which option has the maximum benefits and select that option. So now, let us look at the benefits offered by mutual funds to see if investment in them is justified. But before that, hi, I am Pratap Narula, mutual fund distributor and investment consultant. And if you like my video, please put in your likes and subscribe to my channel. Also, ring that bell to get all future notifications from this channel and put in your feedbacks and comments. Further, put in your questions with regard to anything and everything about mutual funds, especially if you want to get started with mutual fund investing, and I shall get back to you on the same. So let's start with the first benefit of mutual funds, that is professional management. Investors may not have the time or the required knowledge or the resources to conduct their research and purchase individual stocks or bonds. Let me explain that with a couple of examples. If you're not an expert at designing houses, would you design your own house or hire an architect? Similarly, if you're facing a medical problem that you don't know much about, would you take self-prescribed medicines or prefer to go to an experienced doctor? So then, if you're not an expert at investing your money, isn't it wiser to hire a professional fund manager than taking risks investing by yourself? This is where professional management becomes quite useful. A mutual fund is managed by full-time professional money managers who have the expertise, experience, and resources to actively buy, sell, and monitor investments. A fund manager continuously monitors investments and rebalances the portfolio in order to meet the scheme's objectives. Portfolio management by professional fund managers is one of the most important advantages of a mutual fund. Another major advantage of investing in mutual funds is risk diversification. It is always wise to never put all your eggs in one basket while investing, and with mutual funds, you can do just that. Risk diversification is the process of spreading a given investment over multiple asset categories. Diversification helps us create an assorted portfolio that tackles the turbulence experienced in various sectors. Money is invested in a mixture of assets according to one's risk appetite, and hence mutual fund risk is much lower than individual stocks. When you invest in mutual funds, your fund manager will invest your money in different securities, including equity, stocks, debt funds, and other money market instruments. Logic dictates that there is little chance of all instruments not growing to their potential. It is also possible that if one instrument doesn't perform as well as the other, they balance each other out, thereby making your investment much safer. For example, an equity-oriented mutual fund would generally comprise of 60 to 70% investments in different types of equities and the remaining 30 to 40% in various debt securities. Thus, risk diversification is one of the most prominent advantages of investing in mutual funds. Yet another mutual fund benefit is liquidity. In layman terms, liquidity means the ability of an asset to be converted into liquid cash without affecting its market price. Imagine if you have an emergency and need cash but don't have enough funds in your bank. It's not possible to sell property or avail of a loan instantly. But with mutual funds, you have the freedom to withdraw your money instantly. A mutual fund investment is known to be a highly liquid asset and can easily convert to cash whenever you need some liquid funding. Upon redemption, the redemption amount is credited into your bank account within 1 day to 3 to 4 days, depending upon the type of scheme. For example, in respect of liquid funds and overnight funds, the redemption amount is paid out the next business day. Fortunately, most mutual funds don't have any lock-in period. However, please note that units of close-ended mutual fund schemes can be redeemed only on maturity. Likewise, Units of ELSS have a 3-year lock-in period and can be liquidated only thereafter. Also, mutual funds have flexible withdrawal, but factors like the pre-exit penalty and exit load should be taken into consideration, although it is a very minor amount, usually 1% of your fund value. Another important benefit of mutual funds is its flexible nature. For many investors, it could be more costly to directly purchase all of the individual securities held by a single mutual fund. By contrast, the minimum initial investments for most mutual funds are very much more affordable. For example, when you invest in real estate, you must shell out a large sum of money. Often, people can take years to gather that kind of money. Such a long wait can be quite demotivating. But with mutual funds, you can start investing with an amount as minimal as Rs 500. Of course, the amount of investment can be as per your cash flow position. Investors will require a large capital outlay to build a diversified portfolio of stocks. On the other hand, since mutual funds work on the basis of pooling of money, mutual fund investors can have the beneficial ownership of a diversified portfolio of investments with a much smaller capital outlay. Investors can buy units of a diversified equity mutual fund with an investment as low as Rs 5,000 only, or even lower at Rs 500 for an SIP option. Mutual funds offer investors a variety of products to suit their risk profiles and investment objectives. Indian investors can choose from more than 2,500 mutual fund schemes with different investment objectives. Before investing in mutual funds, it is of utmost importance to understand the various mutual fund types and the benefits they offer. Mutual funds are classified on the basis of asset class, investment objectives, fund structure, risk, and specialty. Accordingly, there is a mutual fund scheme to suit the needs of every individual. This covers all possible financial goals that an investor might have. Mutual funds also offer investors flexibility in terms of modes of investment and withdrawal. Investors can opt for investment modes like lump sum investment, systematic investment plans or SIP, systematic transfer plans or STP, and systematic withdrawal plans or SWP. Lump sum investment is when you invest a certain amount of money in a scheme. Systematic investment plan is when you invest a certain amount of money regularly in a scheme. Systematic transfer plan is when you make a systematic transfer of profits from one fund to another on a regular basis. And systematic withdrawal plan is when you withdraw a certain amount of money from a scheme on a regular basis to gain regular income. Similarly, you can invest in growth option of mutual funds if you want to take advantage of compounded returns over a long investment period, or you can invest in dividend option if you want regular income from your investment. An important advantage of mutual funds is their low cost. Due to huge economies of scale, mutual fund schemes have a low expense ratio. Expense ratio represents the annual fund operating expenses of a scheme expressed as a percentage of the fund's daily net assets. Operating expenses of a scheme are administration, management, advertising related expenses, and others. When you buy equity directly, you have to pay costs like brokerage and securities transaction tax or STT. The larger the number of transactions, the higher your costs will be. Mutual funds do bulk transactions and are hence able to enjoy economies of scale which are passed on to the investor. They may, for example, be able to get lower brokerage rates, or a debt fund may be able to negotiate higher rates from debt issuers since they deal in large quantities. In other words, given the unique structure of mutual funds, the cost of managing the fund is distributed among all unit holders. That makes investing through mutual funds more cost effective. The tax benefits associated with a particular kind of mutual fund is perhaps what draws most investors to this investment vehicle. Investments in equity-linked savings schemes or ELSS qualify for tax deduction under Section 80C of the Income Tax Act. One can invest up to rupees 1.5 lakh in this instrument to avail a tax saving of approximately rupees 46,800. That is, assuming the highest slab of income tax at 30% plus health and education cess at the rate of 4% on the taxable income. Tax-saving mutual funds have the lowest lock-in periods of only 3 years. This is lower as compared to a minimum of 5 years for other tax-saving options like fixed deposits, unit-linked insurance plans, public provident fund, and national savings certificates. Another tax benefit of mutual funds is on capital gains. An important point to note in mutual fund investments is that an incident of tax arises only upon the sale of units of a mutual fund scheme. Under tax on equity mutual funds, short-term capital gains are taxed at the rate of 15% and long-term capital gains are taxed at the rate of 10% provided the gain in a financial year is over rupees 1 lakh. Long-term capital gains up to rupees 1 lakh are totally tax-free. Under tax on debt mutual funds, short-term capital gains are taxed as per the applicable tax rate of the investor. Therefore, if your tax rate is 30%, then short-term capital gains tax on debt funds is 30%. Long-term capital gains are taxed at 20% with indexation. Also, dividends paid by mutual funds are taxed as per the applicable tax rate of the investor. Unlike stock market investments, which can be quite a complicated affair if you don't know what you're doing, investing in mutual funds is a piece of cake. All you must do is approach a bank or a non-banking financial institution and they will be able to set up a mutual fund account for you instantly. You can also set up a mutual fund account from the comfort of your own home. Mutual funds are easily accessible and you can start investing and buy mutual funds from anywhere in the world. An asset management company or AMC offers the funds and distributes them through channels like brokerage firms, registrars like Kavi and CAMS, AMCs themselves, online mutual fund investment platforms, and mutual fund distributors and banks. All this makes investing in mutual funds very convenient. Compare schemes, start an investment, redeem units. You can do everything from the comfort of your home. More so, you do not require a demat account to invest in mutual funds except for ETFs or exchange traded funds as they are sold through the stock exchange. Mutual funds are regulated by the Capital Markets Regulator, Securities and Exchange Board of India or SEBI under SEBI Mutual Fund Regulations 1996. SEBI has laid down stringent rules and regulations keeping investor protection, transparency with appropriate risk mitigation framework and fair valuation principles in mind. All mutual fund houses are required to follow the various mandates as laid down by SEBI. This in turn protects the interests of the investors, and complying with SEBI norms is mandatory for all mutual funds. The stringent regulatory environment enables investors to feel safe and confident about their mutual fund investments. Coming to the next benefit offered by mutual funds. Investment in mutual funds are very transparent and easy to track. As mentioned earlier, all mutual fund companies come under the purview of SEBI and they need to make necessary disclosures. SEBI has implemented strict guidelines on disclosures by mutual fund companies. That's why all mutual funds offer full transparency about their portfolio, expenses, net asset value or NAV, and other details like historical performance of the fund manager's qualification and track records. A very important requirement for timely wealth creation is disciplined investing. Mutual funds encourage investors to invest over a long period of time, which is essential to wealth creation. Furthermore, systematic investment plans or SIPs encourage investors to invest in a disciplined manner to meet their various financial goals. Many investors fail to build a substantial investment corpus because they are not able to invest in a disciplined way. Mutual fund SIPs help investors to maintain a disciplined approach to investment. SIPs also help investors take emotions out of the investment process, as very often investors get very enthusiastic in bull market conditions but get nervous in bear markets. By investing through SIPs in a mechanical way, investors can stay disciplined, which is one of the biggest benefits of investing in mutual funds. And finally, a small mention for return on investment or ROI. All investors aim to achieve a higher ROI by investing in financial instruments such as mutual funds to beat inflation and increase their wealth in the long run. Mutual funds have greater prospects of potentially providing higher returns over time, as one can invest in a diverse range of sectors and industries. I hope the benefits of mutual funds explained to you in this video would encourage you for a first investment in them. And I also hope you enjoyed my video. Please do put in your likes and subscribe to my channel and click the bell icon to get new video updates.